you get the title. I'm sure I don't have to explain the title to any of you. If you're junior resource investors, we're all sitting here going, gold's $2,300, copper's 460. What are we, chopped liver? I mean, how come everything isn't going through the roof? I think it's still going to be okay. Honestly, I do think we're starting to see the early, the thin edge of the wedge, if you will, the early buying on some of this stuff. And normally this really is how it goes. I mean, normally when you go from a bear market to a bull market in metals, it's very much a top-down thing. So you got to look for buying on the top line, on the big guys and the medium ones and the small ones. It basically works its way down the food chain. And I think, ironically, and it is ironic, part of the problem that we've had in the last few weeks was the move from the early March until mid-April was so strong. It took a lot of people by surprise, and I think you had a subset of people who, own these stocks all the time, guys like me, that were expecting a move, that weren't that shocked by it, although even I was shocked a bit by the strength of it and the speed of it. But really, any generalist, anybody outside the sector was just going like, anybody who's an experienced trader, you see something move that fast, you do not want to be the last guy in. So you just kind of step back and let's see if this corrects. So I mean, I'm one of those guys that thinks the correction we're having right now is in the gold price, and it's not much of one is actually a good thing. And obviously the other problem, if you want to call it that we've had is Wall Street's been fine, crypto's been going crazy. The Magnificent Seven continue to be magnificent. Well, most of them, not all of them. But basically, there's enough action in the generalist parts of the market that I think generalists just haven't felt any great need to kind of look elsewhere for gains. I think things might get a bit trickier for Wall Street now that we're up in the 4.6, 4.7 10-year yields. You can see that we're at a point where it's starting to make things a little bit difficult. That's the reason I think why the S&P's just been going sideways for the last month. Is I think we've probably got to the limit of yields that traders there can handle without getting really uncomfortable. And the most important thing that I would point out is that does this thing got a no? There's no pointer on this one, right? No. Bottom line there. This is something I talk about often in the newsletter. Through the years, everybody views gold as being very hard and fast. It trades against U.S. dollars. It trades against real yields. Yeah, most of the time, but not all the time. And it's important to keep track of and watch how gold is trading against things it normally trades against. And over the last couple of months in particular, there's been other periods in the last 2 or 3 years, but definitely since the start of March, gold is trading with the U.S. dollar. In other words, it's been going up on days the U.S. dollar's been going up. It's been trading with yields. It's been going up on days yields are going up. Today's a good example. The bond market turned around this morning and yields went up. Gold had a bit of a pullback, but it's kind of come up again. And to me, that's probably the best sign you're going to get that you're in a bull market. When you see an asset class trading with things it normally trades against, in other words, showing a lot of relative strength, trading against other asset classes that normally will trade against it, that's really the most obvious and best sign that you're in a real bull market. And that's really where we're at with the gold market right now. If you take a look at this is a weekly chart of GDX. A lot of people have been, moaning about how things haven't been trading better, but really, if you go back to the start of March, it's up 40%, and it's basically at a 52 high now, basically today. Today, it's hit a 52-week high. We've seen even better on the part of GDXJ. I'll go into that in a second here. That's one of the slides that shouldn't be there, but so I'll be back to GDX in a minute. One thing that's been was sort of the big push. It probably helped this current gold rally start, although I wouldn't overdo it. To me, I think a lot of the important buying was central bank buying, Asian buying. I'm not sure the traditional, gold versus yields, real yields dropping, gold goes up. we got a bit of that, but then it started to reverse last month, and that's what I find very interesting about how well the gold price is traded, is it's trading in a background in an environment where it normally wouldn't trade that well. The chart on the left, that's the Atlanta Fed GDP now. They keep a running chart of their estimate of current quarter GDP, and they basically change it every time a big macro number comes out. That's the current version. That's showing estimated Q2 growth of 4.2% in the US economy. Let me tell you folks, unless something goes sideways or there's some other reason to do it, if the US economy is growing at 4%, we're not seeing rate cuts. So anybody hoping for a rate cut this year, if that's the kind of growth we get, you're not going to see one. Sorry, it's not going to happen. But there is one other thing that these high rates are impacting that I think is probably helping the gold price. That's a chart on the right, and it's probably a little bit hard to read in the back, but basically what that chart is, that blue line you see, that is the estimated interest expense on the US debt, US federal debt for the next 12 months. So you can see there were years there where it really wasn't that big, even though the US has got a big debt number. They've had a big debt number for a long time, but obviously with interest rates at 0 or 1%, it wasn't hurting them that much. I mean, one of the biggest conundrum, and one thing I didn't and still don't understand is really why didn't the US Treasury issue 20 or 30-year bonds if they could find buyers like crazy when rates were 1 or 2%. I don't understand why they didn't do that. It was really stupid because they could have held their rate costs down. Now, if you look at the right side of that chart, like it's basically going through the roof right now, and that's because interest rates have increased, and every month that goes by with higher rates, you've got more and more bonds rolling over at these higher yields. So right now, it's hard to see, but there's you see this little yellow offshoot. That's based on what the interest cost will be for the next 12 months if the Fed cuts 150 basis points, which is what was expected a couple of months ago. They're not going to do that. Maybe they'll cut 25 or 50. I'm not even sure they're going to do that. The blue line that continues upwards, that's the interest cost for the next 12 months, assuming rates are stable. The interest cost for the next 12 months is estimated at 1.7 trillion. That's just the interest cost. That's not the deficit. That's not spending. That's just interest that piles up on the debt that's out there right now. That's your 150. That's what happens if they don't lower rates. So, keep that number in mind. 1.7 trillion just interest costs. That's on top of the deficit. And I think that's part of what's driving the gold price. I've never been a big believer in the whole gold blog. We're all going to die. Everything's going to explode. The dollar's going to zero. I don't particularly want to see that scenario myself. I don't really want to be living under a tree and going out to try to shoot people so I can get a loaf of bread. I'd rather stick with kind of normal status quo. Thank you very much. But I think people are starting to look at numbers like that, and they're starting to get a little bit freaked out, and they're worried about yields, because the irony here is if this keeps going, you can get to a situation where yields will be going higher even though we're in this situation because you simply run out of buyers in the bond market. I don't know what the end game is for this. I don't think anybody knows what the end game is. I suspect we move into something like a fiscal dominance situation. And fiscal dominance is basically where the government, the US government in this case, directly goes in and affects bond yields by buying bonds themselves. Basically, the Treasury tells the Federal Reserve, just keep buying bonds until the yields get back down to 3%. Just buy. I mean, you've seen a variation of that in Japan. The Bank of Japan's done that over the years. Maybe that's it. But anything like that, there's 3 or 4 different scenarios that it could be. But all of those scenarios are kind of gold positive, and I think that's part of the reason we've seen this very basic change in the nature of the gold market. And I don't see anything changing that. It doesn't matter who wins in November. It's always going to be the same BS. The deficits start coming down. This isn't a problem that goes away. So I think the underpinnings of the higher gold price are here to stay for probably quite a while. Now, let me just make sure I'm looking at the right one. I mean, there's the gold chart. I mean, does that look like a bearish chart to you? It doesn't to me. I'm actually pretty happy about this part of the chart. Oh, you drive me crazy. This is actually good. I mean, I know people got a little bit spooked. A lot of the buying came off as soon as gold pulled back, because the top was a little bit stupid where it went to like 24 or 40 or whatever it was. We needed this pullback. Things were definitely getting overbought. And like I said, people outside of the sector that didn't already own these stocks said they were happy about this move. A lot of generalists just kind of backed off and said, yeah, this is too much. I mean, I'm waiting for a pullback. So I think we should be happy to see this. This gives generalists an entry point if they want to use it. I think we're more likely to see money come in. You know, I mean, obviously I'm bullish about gold, but you know, when we get back above 2,400, I think we see more new money come in because people that were skeptics on the first move tend to be there's more believers on the second move than the first move. You need consolidations like this for a bull market. Bull markets can't keep going unless you see this kind of consolidation. So I'm actually happy to see it. And even on the gold stocks, you know, I mean, you know, we're all moaning and bitching, but you know, truth of the matter is, and you know, obviously GDX was like crap until the end of February, but you go from here to here, that's 40% for GDX. GDXJ, it's about 47%. And you know, anybody that's a big gold bug that's always owned all these stocks, I mean, people are very frustrated that the move hasn't been even bigger. But you know, 40% on a 20, let's call it, it's not even 20, 15%, say, gold move, we are seeing some leverage. And the truth of the matter is, you know, the GDXJ, I mean, those are indexes of gold producer stocks. And part of the reason they didn't move together was, frankly, a lot of big gold producers, especially the biggest ones, put up shitty numbers. I mean, the reason they didn't move harder was because they didn't do a very good job of making money producing gold. You look at the Q1 numbers, I mean, the biggest companies, you know, Barrick, Newmont, meh. I mean, Newmont was sort of a beat if you squint, but a lot of the big ones, people were expecting something better. I mean, that wasn't really realistic because, you know, keep in mind, you know, think about the gold chart that was on the previous slide. Gold bottomed right at the start of March. So the Q1 numbers that are coming out now, it's really only March where they were starting to benefit from the higher gold price, where we're really going to, and some of them did. I mean, if you look at some of the mid-size, you know, IAMGOLD, Kinross, some of those companies put up great numbers. And that's having 1 month of gold prices really moving. I think where we really see the good numbers come up, and you know, is going to be Q2, because Q2, assuming the gold price stays here, I think it will, or go higher. The average gold price in Q2 is going to be 15% higher than Q1. Even Barrick can't fuck that up, I think. You know, everybody's going to put up better numbers. And some of the intermediates and ones that have lower AISC and that have a bit more growth in production, you're going to see put up great numbers. And I think for generalists, for funds, for hedge funds, that's really what they need to see. They need to see the sector, you know, the top of the sectors, the producers really putting up good numbers. That's where the buying comes in from those guys, and that buying eventually works its way down the food chain. But they've got to see these companies put up the numbers. They've got to say, you know, who cares if gold's 2,300 if none of these guys can make any money? You know, some of them did great Q1, and I think they're pretty much everybody's going to do great Q2, and some are going to be fabulous. And I think you'll see a bunch of the gold producer stocks, you know, 30-40% higher 3 months from now, and you start racking up those kind of percentage gains. You know, that's when you start getting momentum buying, because, you know, half the market is about momentum. They don't really care what company X does. If the chart looks like the right chart and the Momo's there, the money starts coming in regardless. It's not a judgment on the industry. Most of them don't even care what it does. They're just looking at the chart. And I think you'll see a lot more momentum charts. This is copper. Copper is obviously a much, you know, I would say it's like a simpler, cleaner story. It's basically, you know, it's good old supply and demand, pure and simple. There's nothing terribly complicated about this. I don't know how fast, percentage-wise the copper demand is going to increase in the next 5 or 10 years. I mean, I'm a little less enthusiastic about the green revolution. Some people, just because I can see a lot of impediments on the other side of that. So I'm not convinced the demand goes up quite as fast as some people are arm waving, but it really doesn't have to. You know, the simple truth of the matter is, and keep in mind, I was a guy that was born in a copper mining town. My dad was a mining executive. I've been in this sector my whole life. Getting the mining sector to give you 4 or 5% a year of production growth is pretty close to impossible. It's really, 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 really hard. It's way harder than people on the other side of the equation, the buyers, you know, the Teslas, the utilities, the wind farms of the world. you know, to their mind, they kind of go like, how hard can it be to grow production by 5% a year? Well, try permitting a mine anywhere, anywhere. I mean, the average discovery to production is 18 years for a copper deposit. Are we going to see governments or a subset of governments over the next 4 or 5 years say to themselves, well, we really want this green revolution. We really need more copper. We really need more zinc. We're not going to be so hard on the miners. We're going to try to speed up the permitting. We're going to help them with capital. Maybe we'll help them get some capital, do some low interest loans, make sure they don't get hassled and the roads don't get shut down. Yeah, okay, sure. Yeah, that'll happen. Of course it will. I'm sorry, I grew up in the mining business. I'm way too cynical to believe that. I'm sure they're going to keep being just as difficult. But for us, that's a good thing. Like I say here, and trust me, I winced when I wrote this. But honestly, I hate making price predictions like that, but I honestly won't be shocked if we see $8 or $10 copper in 2 or 3 years. I don't see how we square the circle. I just don't. Like, there simply is not going to be enough supply. Now, the one short-term wiggle we might see, because this is something that I've found a little bit strange in the last couple of months, is this is copper and this is warehouse inventories in Shanghai, and that's, by Shanghai I mean the Shanghai Futures Exchange. The Chinese / Shanghai exchange has arguably become the dominant. It's become the dominant exchange. It's definitely become the dominant exchange for gold. That's part of the reason why gold doesn't. That's part of the reason why this isn't your father's gold market. Is if you look at the way gold trades intraday, a lot of the strength is in Asia. And back in the good old days, when the hedge funds wanted to knock it down, they'd do it in Asia. They can't do it now because there's too much trading volume over there. They just get their heads handed to them when they try to short in Shanghai. Base metals, not surprisingly, are huge in Shanghai, China being China. This big buildup is that, you look at what the copper's done, and this buildup pretty much coincides with the stronger rally we've seen since March. So obviously the buying that was done to be able to get the copper to stick it in the warehouses, that's part of the reason for the current rally. It was a bit of a head scratcher for me. The theory that I've seen that makes the most sense, I don't know that it's true, but it kind of makes the most sense, is there are a lot of traders in China that are expecting a big currency devaluation. I think Beijing would like to do one. I don't know that they can politically. I doubt that they can, frankly. They can maybe let it drop a bit. I don't think they could do like a 20 or 30% devaluation, because they've already got all kinds of trade issues, with the States and with the EU, and that would just explode if they tried to do that kind of devaluation. But it makes sense. Copper, and for that matter gold, if you're sitting in Shanghai as a trader and you think the currency is going to get devalued, buying something that's priced in US dollars makes a lot of sense. I mean, in terms of your internal currency, you've got an automatic gain there as soon as that happens. I'm skeptical about the devaluation, so I would say there's a slight chance, if that doesn't happen or the market just gets off the idea that there's going to be one, some of this copper might come back into the market. I'm not that concerned about it. I mean, the supply-demand equation is so strong, medium and long term. If this actually came into the market and copper dropped back to, I don't know, $4 and a bunch of stocks in the copper space dropped, to me that would be the ultimate buy the fucking dip situation. Like, just buy, because copper's going way higher over the next few years. Even zinc's probably going to do really well over the next few years. If the market gives you a dip like that, you should be buying it, pure and simple. That's pretty much it for me. Basically we're in a bull market. It doesn't feel like that to a lot of us yet, but I think it's coming. I do think we need to see the big companies put up much stronger numbers, which I think they will. I think we will see that start trickling down. These rallies like this always start at the top. The good news lately, not as good as some companies want, is we have seen more financing in the last month or two. I mean, companies seem to be more able to raise money. They're not raising it on terms that they like, admittedly. They're raising on terms I like. I've been writing a lot of checks. I mean, as a buyer, I don't really hate the fact they're giving me full warrants. They're not happy about it, but I don't see that situation, prolonging too much longer. I think the days of full warrants are probably close to over, and I don't think we'll see the kind of discounts we did. But exploration business is a negative cash flow business. You got to get out there, you got to spend money, and that means sometimes as companies you got to raise money, even if the terms aren't really what you want. Because if you're not doing something, if you're not active, you're not going to get any love for the market anyway. So, companies just have to bite the bullet and raise money. But there's been a lot of financings in the last few weeks. So I think this summer is going to be pretty active for the explorers. One thing I'd really like to see and hope that we see is a couple more good discoveries. That's often what draws generalist money into the sector. Company X makes a discovery, their stock goes from $1 to $5 to $10 to $20. It gets to the point where you get enough market cap where it gets noticed outside of the sector. That's often what drives new money. And again, for that to happen, companies have to get out and drill. So that's why I'm fine with the financings. And the one thing that always works, good markets and bad, works better in bull markets, but it is discoveries. And that's why a lot of the stocks on my list are companies that are positioned and drilling for discovery. There's a couple of them here today. Discovery stocks are higher risk. Don't have any illusions. You should be buying baskets, not a single stock. You should be prepared for big drawdowns if the drilling doesn't work. That's just the nature of exploration. But discoveries are the part of this sector that gives people 10x, 20x gains, and that's what makes this sector fun to be in. So, don't ignore the discovery stories. Just decide how much comfort you've got with the risk level when you want to buy these things.